Hey, it's Jim, and this is level one of the CFA program, the topic on ethics and professional standards. And we're in the middle of a conversation on the guidance for standards 1 through 7. Here are the LOSs for each of those 7. You've seen these at least 4 times before, since we are now on standard 5, investment analysis, recommendations, and action. The Institute breaks this into 3 parts: diligence and reasonable basis, communication, and then records retention. A couple of new things for this year's learning module. Most of the new area is in the topic of disclosures, and we'll go ahead and talk about that in just a few minutes. You guys should know by now that I like to send you to the questions at the end of a learning module, but here under the standards of professional conduct, the Institute presents this in just a little bit different manner. There are 17 little mini paragraph cases that I want you to cover inside of this. So we can't possibly cover everything, but I promise you, if you listen to what we're saying here inside of this video and you look at those 17 mini cases and you understand the motivation behind why the Institute is asking those, Standard 5 should be right in your back pocket. And by the way, remember that you're going to sit in the morning and sit in the afternoon. You're going to have 90 questions in the morning, 90 questions in the afternoon. Ethics is, what do they say, 15 to 20%? How about if you just err on the high side? What's 20% of 90? Even I can do that in my calculator. So let's say that's 18 questions in the morning. How about if we cut back to 15 questions in the afternoon? So this is a big part of your ability to pass. And these questions are not too terribly difficult. The challenge is that the breadth, think about that. You have 7 standards. The breadth goes way, way out here. The depth is, it's not too deep, so to speak. But you have to familiarize yourself with all of that breadth. So, get to work. And that's convenient that the first part of our standard is diligence, coupled with reasonable basis. You guys have probably heard me say this before. You'll hear me say it 100 times. Level 2 and level 3, diligence just means putting on your gloves, getting out your shovel, and going out and digging up one of your azalea bushes and replanting it. There's no easy way to do it. You've got to do the hard work. You've got to commit the time and the effort and the brain power. So what are these requirements under diligence and reasonable basis? Well, the Institute is just asking you to go outside, take a look at your garden. What does your azalea bush look like? Where should it go? You do all the research there. But of course, we're not transplanting azalea bushes, which, by the way, is on my schedule to do here in the next few days. But we're talking about fixed income securities, equity securities, and alternative investments. What does that mean? We need to dive in and know everything we can possibly understand about those 3 types of securities. We need to be thorough. We need to be independent. The last thing I want to do is have my neighbor come over and say, you know what, Jim, I think you ought to do this. That'll help you transplant your azalea bush. I'm not listening to my neighbor. I'm going to go do my own research. I have this all planned out. I know exactly what I'm going to do. And then, of course, after all of this, we're going to make an investment recommendation. And this is very similar, those of you who are sports fans who like to watch soccer or football or basketball or golf or maybe the Kentucky Derby. We're trying to pick a winner. Now, the difference between what we're doing here inside of the program and trying to pick the winner of the Kentucky Derby is quite simple. Those are static events. So you do your research for a day or two and then the race goes off and then you worry about the next race. Here, we have the entire economy at our disposal and we have it on our team, right? The economy is expanding, then our fixed income security, our equity security, our alternative investment, that's going to pay off. Now, of course, what we want to do is we want to have it pay off being consistent with our client's risk and return objective. We need a reasonable and adequate basis. What does that mean? This is super simple. I'm going to get my shovel. I'm going to go out there and I'm going to dig and I'm going to transplant the tree. I'm going to dig the bush. I'm going to dig another another hole. Maybe I'll put some fertilizer in there. Maybe I'll put some mulch in there. Maybe something else. I don't know. Whatever it is, I'll go out and do it. But that means for fixed income securities, reasonable and adequate basis. What we need to do is figure out what is and I'll just pick two. We need to figure out what's the interest rate risk. So we need to know about duration and convexity. And what is the default risk? So we need to know about bond ratings agencies and credit default swaps. So what does this recommendation ask us to do? Supported by appropriate research and investigation. We're going to cover all relevant issues. The level of diligence depends on the product. I mean, if we have a client who says, you know what, Jim, I want you to invest in money market securities. Well, treasury bills, bankers' acceptances, CDs, we know all about those. So our level of diligence is probably not going to be as it were if our client said, hey, you know what, I want to invest in a credit default swap and I want it on this kind of security with this much of interest rate risk, et cetera, et cetera. Well, that's a lot of hard work. So think about the investigation and the diligence for a money market fund as, you know, going to the hardware store and buying 5 tulip bulbs and going out and digging a hole 6 inches down, shoving them in there. You pat it, you water it. You know, that's pretty easy. But if we're going to transplant an azalea bush or maybe a Leland cypress tree that's 7 feet tall, well, then we need to work a little bit harder. So depending on product or service offered. And then, of course, I've done all sorts of crazy research on azalea transplanting, but financial statements, company reports, third-party research, and you hear me say this all the time, read the Wall Street Journal. Of course, I get nothing out of making that recommendation, but the Wall Street Journal is it's the most cost-effective newspaper that you can ever buy. The tons of information that's in there. It takes me days to read just one issue. How about that? Try to figure the math out of that one. Now, of course, I've used secondary research, third-party research, fifth-party research. I've asked my cousin and my sister. I've asked everybody about transplanting azalea bushes. Well, you know, suppose that I asked my cousin about the riskiness or the payoffs of a credit default swap. And my cousin knows nothing about it. And he goes, oh, yeah, that'll be fine. As long as interest rates stay about the same, that credit default swap will pay off. Well, if I'm listening to my cousin with the azalea bush, he's an expert out there. That's one thing. But I'm not going to listen to him about credit default swaps. So what we need to do is make certain that when we use somebody else's research out there, that we make sure that if we were to perform that research, that we would have done the same thing. We just don't have the time. We don't have the effort. And a lot of times it's just marginal cost, marginal benefit. It's easier to just say, you know what, I'll pay you $10 if you want to do this over there. Now, what we'll talk about here in just a little bit is the disclosure, and this is super important. We need to make sure, especially if we're facing a client, we need to make sure that we disclose all the stuff that they do over there, including and specifically their fees or their costs. And we have a little example there, 5 years, 2 years. You know, I think it's reasonable. And look, that's the standard, a reasonable basis. You know, my wife, she just is so critical of me sometimes in a very fun way. I have every one of my tax returns going back to, I don't even want to tell you what year, but way before you guys were born. And she says, why are you keeping these? And I was like, hey, maybe someday I'll need them. So you don't need 100 years worth of reports or research, but something that's reasonable. Maybe 5 years is fine. Clearly, it's more complete than 2 years. So I'm guessing if the Institute asked this question, and of course it's in a multiple choice format here at level 1, if they give you a choice between 3 and 6, pick 6. How about that? If they give you a choice between 3 and 100, like Jim's tax returns, don't pick 100, whatever you do. I like this second embedded point. I'll say this to you regularly in all phases of the program. that the Institute is very big on monitoring and reviewing and saying things like, okay, this is what we said we were going to do, and this is what we did. What can we learn from that? So periodic review is super important. Now, throughout the CFA program, we're going to talk about extended and complex and complicated models, some of which we've already done here in Level 1, the capital asset pricing model, bond pricing model, the Myron-Gordon growth model. We'll talk about Black-Scholes-Merton option pricing model. We'll do time series at Level 2. We'll do lots and lots of derivative securities in Level 2. We'll have an interest rate tree. So of course we're going to use these quantitative oriented research models. And what we need to do is make sure that we understand them. That's why you're going through the program. Hopefully that when you pass Level 1, Level 2, and Level 3, you'll understand those models and you'll be able to educate your client on those models. Now, you're probably never going to sit down with a client and explain the 5 variables, the 5 input variables of the Black-Scholes-Merton option pricing model. But what you're able to do is you're able to take that complex model and extract out the simplicity of it so that you can say to your client, hey, you know what? If the stock price goes up and we own a call option, well, the call option is going to increase in value. I mean, anybody can understand that kind of a relationship. You're going to have lots and lots of assumptions. And over the next Level 1, 2, and 3, you're going to be faced with questions about the assumptions underlying these models. So it's important that you know these assumptions and the underlying characteristics. There's an example and an arrow point at the bottom. Now, not only do we have to understand the model, but maybe we're going to go ahead and develop a model based on a fundamental financial model. For example, in Level 2 and a little bit in Level 3, we'll talk at length about the Black-Scholes-Merton option pricing model, and maybe you'll have to calculate the price of a call option using those inputs, which means you're going to have to look at a Z table. We'll call it a D table when we get to it. Now, if we develop a model, one of the inputs is the standard deviation of the underlying asset. And this is really the critical variable in that model. And what we can do is maybe we could come up with a better way to estimate that standard deviation that gives us a more accurate and more efficient price. So what we need to do is we need to test that model to see if our new, how about if I call it that, our new standard deviation works better than maybe the old standard deviations. I have a good buddy from graduate school who works for a humongous wealth management firm, and he has said to me over the years, he said, boy, I wish I could share with you our inputs for the Black-Scholes-Merton option pricing model, but of course he's bound by confidentiality, and being a good holder of the CFA designation, he honors that confidentiality stuff. And me as a good member, I don't press him to violate that confidentiality agreement and part of the standards. Important that the inputs stretch beyond historically observed values. Yeah, this is what we're going to see as we go through the program, is that sometimes the historical, let's say stock prices or bond prices, those things are a really good place to start. However, what we need to do is go beyond those history and those history lessons and what we can learn from history, and we need to add a little bit to it so that we can predict the future. I mean, sometimes the past predicts the future, but sometimes it doesn't. Sometimes you need some kind of an adjustment. We'll do lots of this stuff at Level 2 with time series. When we select these external advisors and even sub-advisors, some of these advisors will hold the designation and some will not. So we need to make certain that if they hold the CFA designation, we need to go ahead and just do a pretty quick quiz with them and say, all right, look, I see that you hold the designation. Just convince me that that you remember all the stuff that you learned from Jim back in Level 1 and 2 and 3. And that'll be an easy thing. They'll say, yeah, I'm a member in good standing, of course. And so we have respect. We have respect for each other. But then if they do not, well, then you have to say something like, all right, how about you or your firm? Do you have your own code? What does that code look like? And what you'll probably find is that the code probably looks an awful lot like what we're going through with these 7 standards, but they're probably not as broad and probably not as deep and probably not as well detailed. Let's move on to the possibility that we're going to perform due diligence with a reasonable basis inside of a group. Wouldn't it be wonderful if we had, let's say, 4 or 5 group members and we all thought alike and we all did the same kind of research and we came up with the same conclusion? We decided, hey, let's go ahead and recommend this credit default swap for these clients. Well, the problem with that is that you have some behavioral issues, and we'll talk at length about behavioral finance and the biases. We have cognitive errors and emotional biases. That those problems arise inside of a group. But that's not really what we're talking about here. The issue is, let's suppose that we have 4 or 5 group members and they say something like, hey, you know what, let's recommend this credit default swap. And I or you guys say, you know what, I'm not so sure that I agree with that. The question then becomes, what do we do? What do we do if we disagree with a group recommendation? And these are 2 good questions here. I mean, the idea is that as long as I am confident in my other, let's say it's 5 members in the group, the other 4 people in the group, I've been working with these people for 100 years. I know their integrity. I know that they do hard work. I know that they know how to transplant an azalea bush. I know they know everything about a credit default swap, yet I just disagree with them. If I'm confident about the process, I can still leave my name on the report. And I do not have to take my ball and play in another court. I don't need to dissociate myself from that group report. So that's important. And the Institute is probably going to go ahead and put together a question in which they suggest that because you disagree with the recommendation that you should just keep your name off of the report. And that's really not true. I'm guessing that you could say, hey, you know what? I don't really feel comfortable with my name on there. And that's okay. Does it really matter if it's a group of 4 or a group of 5? It's okay if you don't put your name on there, but you're not required to do it. Let's finish this section with an example question. Here we have Philip. Mid-sized asset management firm, relies heavily on external research. All right, we subscribe to a service, reputable firm. They were recently awarded a prize for stellar research, North American durable goods sector. Hey, that sounds like an awesome award to have. Confident in the rigor, quality of the research published, and does not perform any independent due diligence to determine quality and accuracy of the data. All right, so we like a whole bunch of stuff in here. We've got this firm. Here's a research firm. We know they're winning awards. We know they have rigor. We know they have high quality. However, we don't go out and sample some of the stuff that they've done to confirm, right? We're not going to just absolutely rely on their report. So the question is most likely a violation. And get used to this. You know, A, none of the actions violates, and then you'll have 2 more choices in which they do. Use of external research. I mean, of course you can use external research. I'm going to rely on my cousin Joe for the azalea bush stuff, but I'm not going to rely on my cousin Joe for credit default swaps. I mean, that makes perfect sense. Failure to perform due diligence. So there's the answer there. What we can do is we can make certain. Now, we don't have to re-perform all that research because, after all, we're paying this boutique to do the research. But we need to go out and try to verify parts of it. Now, the Institute is not real clear about what kind of parts, but that falls under the reasonable basis. How much independent verification do you need to perform? Well, this is just a matter of experience on my part. I mean, I would pick something and just go and say, you know what? I'm going to do this research on my own, this little part. Maybe it takes me 15 minutes. Oh my gosh, my research shows that it's the same as there. Then I'll do something for 10 minutes and then 5 minutes. Boy, don't answer the questions like that on the CFA exam. But you get a sense, 15 minutes, 10, maybe it's 15 hours and, gosh, no. If we're doing 15 hours and 10 hours and 5 hours, and what the heck are we paying these people over there for? All right. All right, how about the second part, communication? And here's this is what I said in the introduction. Here's the new part of this reading for this year and this year's learning module, that we need to be very careful that, of course, the Institute wants us to disclose, disclose. But if we are facing the clients on a regular basis, and we are using, and let me just go back here, and we're using, like Philip did, this reputable boutique research firm, well, what we need to do is make certain that we disclose. And this could be an affiliate, it could be a related party, it could be a third party, it could just be my cousin Joe. We need to make sure that we disclose not just our costs, but their costs as well, and those fees. All right, so the first thing, this makes sense, right? Disclose the nature of the services provided, information about the cost. So I added a little bit extra to the cost, but we have a couple slides here that do this. Why are we doing this? To protect the client interests. I mean, this is so obvious. I'm not sure I even need to say this. Of course, there are going to be issues where we put the client in a portfolio and the portfolio doesn't perform as well as we would like, and then we have these fees in there. And so the client's going to come to us and say, why am I paying you all these fees? And we get out the policy statement and we say, oh my gosh, here they are. They're right there. It doesn't say you have to pay me these fees even if I stink, or even if that boutique firm stinks. It just says you have to pay these. All right, so that's important communication. All right, what kind of services do we provide? Are you going to write down fixed income? Yes. Equity securities? Yes. Alternative investment? Yes. So do the nature and scope of all these. Are you going to write about transplanting the azalea bush? Probably not. What are the requirements down in the bottom? It requires comprehensive disclosure. So this is what I was saying just a few moments ago. Disclose, disclose, disclose. Now, here are the costs, and make sure that you are aware that we need to disclose our costs as well as those third party or the affiliate costs. Associate costs to clients and prospective clients. There's a little mini case inside of this learning module where, and let's see if I can get this right. What we've decided to do is go from using an average, like a weekly balance or a monthly balance, I can't remember. You'll see this when you look at the learning module, to using either beginning of year or end of year balances. I can't remember exactly what it is. And so you just need to make sure that you disclose that we have changed from one fee structure to a different fee structure. So there we go. Disclose services and associated costs, all expected charges if we're changing. Some other issues out there, maybe this will show up as perhaps just one question. Notice in that first bullet point, look at the word down there under the second bullet point, indented, must update the disclosure. So this is really critical. Sounds like a great exam question where our firm lists all these fees and costs, and then sometimes during the year, maybe it's December 15th, and we change these for the last 15 or 16 days of the year. You need to do it right on that day. You need to update those disclosures. The scope, look at the example there. There we go. Affiliates. Didn't I just say that affiliates, related entities, or third parties? That's the new part of this reading. So make sure that you highlight this in your notes. A good question might be something like, hey, here's a list of all of ours. And because Jim's cousin Joe over there, he's a related party, you don't need to worry too much about those. You don't need to worry too much about his fees. So that would be a violation. Best practice of the manner, make sure that you pick up the phone and call, send an email. I don't know anything about social media, as you know. I don't know. Can you tweak these things? Probably not. Do you want to put it on Snapchat? Probably not. I don't know anything. Maybe they're appropriate. I'm going to guess that they're just not. Anything that's on social media, I'm going to be not in favor of for just whatever reason that I can come up with. But look at the best practice down there. Make sure you put it in written form. And if you email it, you just keep a record of when that is. Yeah. So what's our requirement here? Basic format, general principles, promptly disclose material affect these processes. Now, of course, we're going to have a client who calls us every single day and says, boy, I'm looking at these reports, I'm looking at all the disclosures, but somewhere in between disclosure 627 and 628, I don't really see anything in there. So if that client says, what is 627 Part B? Well, then you need to make sure that you make that available to that particular client and everybody else out there. Yeah, what is a research report? When I was going through the program, over 2 decades ago, this is just when internet just became, gosh, I don't even remember if I even knew what the word internet was in the early 2000. But nowadays, I don't know what all this means. Can you Snapchat a report, like I was saying a few minutes ago? Yeah, research report is not just the old annual report that was issued by these companies back in the old days. Now, remember what I said earlier, we're trying to pick a winner inside of the Kentucky Derby. We're trying to pick undervalued stocks. We're trying to pick bonds that are going to be upgraded. We're trying to pick alternative investments that have low correlations but have higher expected returns. Well, we need to disclose all of those kinds of concepts. I mean, clearly we can talk about returns if we want to, but the focus here are what kind of risks. So, of course, you want to mention things like standard deviation and beta. And that might mean absolutely nothing to some clients, but that doesn't mean that we're not required to disclose. Of course, a bond rating, that would be important. And then some limitations or restrictions that sound something like, you know what, this ratings agency, they rated these bonds before, but they made a mistake in 2008. So here's the rating now, and let's be aware that these ratings have some kind of a time lag. Maybe they're performed by somebody who's no longer with the ratings agency. Maybe the economy has changed in such a dramatic fashion that we're looking for some kind of a change. Look at this. The standard communication with clients and prospective clients. What I would love to say is let's just combine that communication, clients and prospective clients with a reasonable basis. The Institute, they don't ask us to do anything that is unreasonable. Yeah, some risks should be well explained. So this is what I was saying about beta and standard deviation and the Sharpe ratio and Jensen's alpha. But what you're probably going to do is disclose these in more broader fashion. So with credit risk, you'll probably talk about the bond rating. With country risk, you'll talk about exchange rate risk and political risk. If you have industry risk or market risk, you'll probably talk about beta, maybe value at risk. Counterparty risk, maybe you'll talk about third way risk. Remember, what did I say? Third way? I meant wrong way risk. Counterparty risk, that's just essentially default risk. Yeah, understand the limitations. I just had a lecture in my investments class the other day. We went to Morningstar and we took a look at a mutual fund. We did the Janus 40 fund, so we went through all that stuff that's inside of there. And I said, all right, suppose that we clicked over here somewhere in Morningstar and we could come up with the Janus hedge fund. How different would this look? And so we went through, probably a 30-minute lecture about the difference between a hedge fund process and a regular old equity mutual fund process. So make sure that the client understands all of those limitations. And then look at that third one there. This is a really good exam question. So the question is, CFA Institute does this. Hey, here we are. We're disclosing we own some kind of a security. And if the interest rates move in this direction, which we think they're going to do, oh my gosh, then you'll make this much in profit and your P&L statement will look super de-duper, et cetera, et cetera. So yeah, make sure that you say, okay, if interest rates go up, one thing happens. If interest rates go down, then something completely different is going to happen. Something completely different. There's my Monty Python reference for the day. If you guys don't know who Monty Python is, go watch The Holy Grail as your homework assignment. All right, what else must we do? Well, there's that reasonable word. Again, I love that word. Judgment in identifying factors that are important. What are the factors that are important with transplanting an azalea bush? Well, whatever they are, dirt, shovel. What are the important factors for determining whether a company like Johnson & Johnson is undervalued or overvalued? Well, of course, all the macro information is important. GDP, interest rates. Industry information is important, and firm-specific information is important as well. So we need to make a reasonable judgment out there. The example that I give students all the time, I'll say something like, dividends, does that sound reasonable? Yep. Reasonable and relevant? Yep. Merger and acquisition activity, reasonable and relevant? Yes. Number of clouds in the sky? Of course not. So if you get a question where the institute says number of clouds in the sky, mark that down as irrelevant. Yeah, of course, as well-trained analysts, it's up to us to decide which factors to include or exclude, but we're going to include those that are reasonable and we're going to exclude those. Now, if we omit something, we probably need to disclose how that omission is relevant to what's going on in the future. I mean, for example, you could have gotten away from, let's say, the year 2000 to the year 2000. What year was that? 21. You could have said something like, inflation is 2%. We expect it to be 2%. It is going to be 2%. It's just going to be 2%. So we're going to not focus inflation as one of our input factors or our risk factors because we think it's just going to stay at 2%. Let's find some other factor out there. Maybe it's default risk, maybe it's maturity risk. Whatever it is, we'll find that factor. Okay, what factors are important? But then, of course, inflation. What year was that? 2021. It was over 9% here in the United States. All of a sudden, that becomes relevant and important again. So my inflation example was probably not the greatest example, but things happen over time and factors change and their relative importance changes. And that's why we're going to spend tons of time on time series and regression analysis in level 2. I don't ever go out on a limb. I want to go out on limbs in guaranteeing questions on the CFA exam, but I don't ever guarantee. But I'm going to go ahead and say this is a super likely exam question. Make sure you distinguish between fact and opinion. You've probably read about this. Maybe you've heard this from other candidates. This is an important one. And the Institute is pretty clear when they put together these practice problems and the mock exams where opinion is an opinion. Like, I believe that interest rates are going to go up. Well, that sounds an awful lot like opinion rather than, hey, the rating on this bond is BBB. How do we communicate these opinions and facts? Well, if we have an opinion, that's okay. We can tell the client, hey, it's our opinion that we believe that interest rates are going to rise. And if our opinion changes, then we need to make certain that we tell them. Now look what we have in bold. Facts should be separated from statistical hypotheses. What I would do, my suggestion is for you as you're going through these problems, is to decide on, when you're reading this, which is fact and which is opinion, and then highlight the fact and say, okay, this is a fact, and then underline the opinion so that you can remember this as you're going through all the questions. All right, let's talk about Regis Partners here to end this section. Large cap European stocks, minimum market cap of $5 billion. Okay. The economic outlook, growth prospects diminished over the past year. All right, so we have this. We have a fund, and what we're worried about is the growth rate. So if the growth prospects have been reduced, then maybe we can't even call it a Euro large cap growth fund anymore. So to broaden this, we change to market cap of 2.5. All right, this is okay. Marketing and promotional material informs all current clients about the updated investment process, but does not feel the need to update any prospective clients of the firm. Oh my gosh, this is an explosion right inside of your brain. We liked everything. We liked everything till we got down to that update prospective clients. I mean, look at the standard. It says communication with clients and prospective clients. It doesn't say communication. It doesn't read. It doesn't read communication with clients. And sometimes when you feel like it, or if the mood hits me, I'm going to inform my prospective clients. So there you go. That's clearly the correct answer. Now, what we've done in part A and B is we've done a lot of work. We've done a lot of disclosure, and after all of our recommendations and forming these efficient portfolios, satisfying our clients' risk and return objectives, we need to look back and say, you know what, do I have any idea what I did over the last 2 months? So part C of this standard is to make sure you keep a record. Now, you can wag your finger at me. You can say, Jim, please tell me I don't need to keep these records like you've done with your income tax returns. Of course not. But again, this standard could read record retention and reasonable basis. You know, how long do you need to maintain appropriate records? Not 100 years, but probably longer than 2 years. But not only do you need to keep the records, you need to keep all of the supporting documentation. Personal notes, third-party, press releases, all that kind of stuff. Hard copy or electronic form, that makes perfect sense. Now, do we need to keep track of all of our tweets, our text messages, our blog posts? Yeah, we have to. You know, there are creative ways to store all of this stuff. I myself don't know how to really do all this because I don't tweet. I do text my friends, of course, and my family members, but those are private texts that I would never want to be made public. I don't do anything about blogging. I mean, maybe I should have Jim's Azalea blogging thing, and so I can say, hey, this is what I did. But then I get it, probably 100 people will say, Jim, you did that the wrong way. Didn't you perform your due diligence? Rah! Yeah, I don't need that stress. I'll know if my azalea bush dies by July if I did it the right way. Records are property of the firm. I'll tell you just a quick story. Whenever you run into someone who holds a PhD in finance, they would have had to have taken and passed what are known as comprehensive written exams. And some of my peers, when they took these exams, they went to the professors and said, hey, can I look at my results? Can I look at my answers? I'd like to see what I did wrong or whatever. And that's just not the way it works. Those are not the property of the taker of the exam. In fact, when my professor called me, he called me on the phone one Friday morning and said, he goes, hey, Jim, I have some good news for you. And I have no idea what he said after that because I passed those exams. I didn't care what I wrote on those things. I didn't want to look at them ever again. I could have drawn Santa Claus in there for all I cared. Anyway, so, the records are the property of the firm. So the great question is, here are my 5 clients. They're my 5 favorite clients, but I'm going to go work for somebody else over here, or I'm going to start my own firm. I feel like I'm entitled because I've known these clients since the day they were born, and they're going to want me to take their records over there. But, you can't do that. Now, of course, if you ask your employer and your employer says, you know what, you can go ahead and take this and this, but not that and that. So the good questions here are mostly who owns the records, of course, the firm, and then what happens if you leave? What can you do? And so here's some good examples. Local requirements. I mean, here we go. The CFA Institute, they say, 7 years. That's an easy number to remember, 7. But you might have to, if you're operating in a country that might have some different rules, you might have a municipality, you might have a firm that have different rules that says, you know what, Jim's onto something. Make sure you keep your tax returns going all the way back to 1988. Oh my gosh. And just have your head explode if you have to go that far. Clearly, you won't have to go back to 1988. let's end up with a final question here. Let's see, we manage a high net worth client. We've done the policy statement. We're replicating the composition of an index. All right, the index has 30% of the healthcare. So far, so good. Experiences an unprecedented series. How many times have we heard that word from politicians over the last 5 years? Unprecedented. You know, sooner or later, unprecedented is not going to be unprecedented anymore. Resulting in poor performance. After catching a glimpse, a client turns livid. Oh boy, there's a really good word. You'd never want a client to be livid. I don't imagine the Institute would use the term livid, the word livid inside of one of its questions. It'd probably just say disappointed or angry. Ms. Young has allocated too much money to this sector. What's the question? How could we best approach this situation? Well, based on the conversations that we've just had, we're going to show a picture of the azalea bush beforehand. We're going to show a picture of the hole that we dug, and then we're going to show a picture of the azalea bush after it was transplanted, and then we're going to show a picture of it being dead, right? There's the poor performance. And we're just going to say to the client, look, you knew about all this from before. So the question is, look, if we keep all these records, we knew that healthcare was 30%, and here I'm going to show you whether or not we calculate that 30% with, an average monthly balance or beginning or end of year market values. However we decided to do it, well, here it is, and this is what we did. All right, so what does this good answer tell us? Yeah, appropriate benchmark, explained appropriately, in compliance, yeah, all that kind of stuff. All right, so that takes us through standard 5. I want you to go and read those 17. They're just, quick, maybe 3-4 sentences. I want you to go look at those right now as you have this in comfort level of your brains. And I will see you on the other side. The other side is standard 6, conflicts of interest. So, hey, thanks for watching. I really appreciate you guys spending time with me. I have lots of fun making these videos. I don't imagine it's nearly as much fun for you guys because you have the pressure of taking the exam. I don't have the pressure of taking the exam. In fact, I just talked to one of my close buddies, teaches at a major university in the middle of the country. And we were talking about CFA stuff. And he said, I'm glad I don't have to take that test now. We both did this 2 decades ago. And I was like, dude, you could pass this. You could pass level 1 like this right now. So anyway, thanks for watching. Hope you're having fun. And good luck studying.